So the third lecture is going to be on risk and returns. Okay. Now, assessing the market, the main thing we assess when we want to invest in securities is the risk and return. Okay. So we are going to do the risk and return again. I'm not going to stress myself much because you've already done it. Okay. So this risk and return. Uh, so let's to see the introduction. So investor, uh, when you invest, okay, whenever you hear you're going to invest in something and they give you high return, you look at the return, look at the mutual fund now. Like mutual fund is 8.6. Is it 8 No, treasury bill is 8.6. Mutual fund is what? Is it 8.5? Yeah, mutual. But sorry, that's a mutual fund. Oh, what's the name of this? Monetary rate. Monetary rate is now, I think it's 8.5. Yeah. You are looking at all these things, treasury bills. Then they give you a certain investment, and now they person strangely come and mention 15%, 20%. You have to be curious. If they are not duping you, then the risk associated with such investment is what? It's very high because high returns come with high risk. Okay. So because the return is high because every additional risk you take need to be compensated for. So that's why you are being compensated by being given a higher return. Okay. Then um now the purpose here is for us to maximize our return and minimize our risk as best as we can. Okay. So what is risk? Risks are what? Uncertainties associated with what? Investing in this one, we are talking of securities, so investing in securities. Okay. And we know, if you don't know, it will be strange. We know that risk is measured with standard deviation and variance. Okay. So that is it. We have types of risk. We have systematic risk and we have unsystematic risk. We are when we talk of systematic risk, which also not market risk. It is a risk that affects the whole economy and it cannot be controlled. It cannot be diversified. So if now interest rate is low, there's nothing you can do to try diversify it. Okay. If inflation is high, what will you do? It will definitely affect you, but you can't do. So these are such risks that exchange rate becomes very high. Then there's nothing you can do about it. Okay. You can't do anything. It affects every investment. It affects every investment. Now we have unsystematic risk. Yeah, this risk is specific to a particular firm. That's why if you are going to invest in a particular firm or the shares of a particular firm, you are going to in the bond of a particular firm, you need to do the assessment, security assessment. And I think last week I told you we have fundamental analysis and we have technical analysis. I've been told we have quantitative analysis, we have qualitative analysis. There are some of the things you do. Fundamental, you pick their financial statement, you are studying the financial statement, you are studying the industry they find in, you are studying the economy that you find themselves in. Okay. This is some form of fundamental analysis that you are doing. Technical, you are looking at the trend in their price movement of their shares and all that. You are looking at all that, you are looking at even their reputation in the economy, right? So their reputation talk much because MTN has a very good goodwill. It has how do I put it? A very good goodwill. Seriously, it has a very good um reputation. Okay, so it's like everyone want to invest there. Even personally, if I go to especially a firm, I'm purchasing something I want to buy, I want to pay with my mom. Then all of a sudden they tell me, oh, we are not using MTN, we are using others. And I'll be like, what? Can this big firm you don't have MTN? Because it's like most of the people who come and pay, they are going to pay with MTN. So because it has good reputation. So you assess, so this is a qualitative analysis, okay, that you are doing. So of all this, I want to invest in telecommunication. Of the three or more, I don't know. We have three, right? We have Telecel, we have MTN, we have Tigo. Tigo what? We have Tigo and what?
It's Airtel Tigo.
Airtel Tigo. We have Airtel Tigo. I don't know
Now,
what
now we only
the
have
Glo
MTN and then Telecel.
Telecel, yeah. So
Yes,
among these three,
Airtel today has been bought by, I think, Telecel.
they bought it. So now we have two.
Yes, we have two.
Oh,
The Telecel is Vodafone.
yes, I know Telecel is the Vodafone. So now we have
Yes.
Yes,
two.
now they have acquired 80.
Oh, really? So we don't have
Yes,
Airtel Tigo again.
no, Telecel has acquired it.
Okay, okay. So now we have two. Hey, all right. So that is it. Now the reputation MTN has built, the reputation itself. Okay, it's like everyone has MTN SIM. I don't know who doesn't have MTN SIM. There's nothing like everyone, but I believe that 99% of Ghanaians have have MTN SIM. Okay. So, and when it comes to mobile money transaction, most of them are using the MTN. Okay. So you do all this assessment that is specific to the firm. Then you diversify before you choose the firm, and you diversify. After diversification, we have told you that diversification reduce risk, because this MTN that we are praising today, we don't know what will happen tomorrow. We don't know what will happen tomorrow. Do you get me? So no matter how good the firm is, it cannot be 100%. So that is it. Then returns. Return is the gain or loss you make on investment. So if you are invested and they tell you are going to get 25%, I don't know, I should have reduced this. These are old notes, because where our rate is now, there's nothing like 25%. But anyways, this is what the question, you get 25%. It means you are going to get what, 100. So that's the return you are going to make. At the end of it, you're going to get 2,500 back. Okay. Then we have share return. So you buy shares at 750, you sell it at 900. That is capital gain. So this is the return you are getting, which is what? 150. Okay. So now you want to see the rate of return. Then now when you go to your mathematics, 150 over 750, the price, the base price, then you multiply by 100, and you get your what? 20%. Now, single investment analysis. When we talk of single investment analysis, that is when you're assessing a single investment. So we assume that this person has invested in one particular shares, the shares of a particular firm, just one. Okay. So that is what we are basing on to do the analysis. So we have two methods for assessing investment, and we have historical data, using historical data, using probability data. Okay. So let's use historical data. Imagine you were told that you have this, you want to invest in a firm, then you are doing the assessment, and you were told that, oh, their return they had for last 5 years was 10%, then they had 20% for last 4 years, last year was 15%, last year was 5%, this year they made 7%. Now you want to see the mean of what they have average, what are they going to earn? Okay, they will earn. So you now take the amount and you add them. This is what I converted decimals. Can use percentile decimal, then divide it by 5. And you get your answer. Okay, so that is for historical data. Okay. Now the variance, because I told you the variance is to measure the risk. Okay, so the variance is sigma, remember, sigma s minus the mean. So the return we got, the return, so sigma of the return, the individual return for the year, minus the mean that we got, the return, the average return that we got. That's the formula. Put raise the power 2 over the period minus 1. So you can see that the return they got the first year, I'm subtracting the mean from it, raise the power 2. The return they got of the second year, I'm subtracting the mean from it, raised apart. They return the code for the third year. I'm subtracting the mean from equal to power 2. They return the code for the fourth year. I'm taking the mean from raised to power 2. They return the code for the fifth year. I'm taking the mean for equal to power 2. So the mean is the number of period taking place is 5. That is the n minus 1. So after doing other calculation, that's what I got as the risk in terms of variance for the firm. If I want to compare to the standard deviation, I'll root it. So you see that I've rooted it here, and standard deviation, that's what I'm getting. Then I want to get the covariance, coefficient of variance. Then we are going to get standard deviation over the mean. So standard deviation over the mean, and you get 1. This is just revision, right? This should just be revision. Then when we want to use probability data, because I told you it's either use historical data or probability data. So this is the probability data. They are saying that in a weak economy, the firm is likely to get negative 0.08 at a probability of 0.2. Then in a moderate state of economy, the firm is likely to get return of 10% or 0.10 at a probability of 5, that's 50%. Then in a strong economy, when the economy is very vibrant, the firm is likely to get 0.20. Then at a probability of 0.3. So that's what information we have, and they're asking to know the return and the risk. Okay, so this is the expected return. This one is sigma return time probability. So the returns is here. The first return is 0.08, negative 0.08. That's a loss times the probability plus the return for the moderate period times the probability. Then the return for a strong economy times the probability, and that's what we are getting. Then we have the variance. Okay, the variance is sigma return minus means times probability. So that is it. Okay, so the variance is the return minus the mean times the probability. The return minus the mean times the probability. Then this is what we have as variance. We determine the risk of the firm times, we square it to get the standard deviation. Then we divide the what is this? This has escaped me. What was it? Standard deviation over the mean. Okay, and that's what we are getting. So in making investment decision, we'd have to choose high return for the same risk. Okay, so we prefer high return. So if you have a firm that all have 5% or 5% risk, then one, the return is 9, and one, the return is 8. You definitely go for the one, right? For the one with 9% return, okay? So that is it. So you compare based on, and you choose the one with the lowest risk. So the lower CV here, they are talking about coefficient variance, okay? So that is it. So we are done with investing in single investment, and we have done the analysis, both historical and probability, and we know why it's important for us to do that, because we cannot be doing try and error when it comes to investing in securities. So we are going to end here, and then my assignment is going to follow. So you are going to learn portfolio and diversification. I have to send the lecture note. Maybe I have to send the lecture note and update it once more, because I've not finished. I'm doing a whole lot of updating adding new topics and stuff. So I'll send it. I'll send what I've done. I'll tell you what I've done. So, and you've already learned this. So you are going to, that's your assignment. You are going to